Bring in show music, please.
Hi, I'm CNBC producer Katie Kramer. Today on Squawk Pod, famed hedge funder Boaz Weinstein, a rare interview on Wall Street's latest power struggle.
The retail investors are some of the least sophisticated investors in the world. The president of BlackRock, I sat in his office, Rob Capito's office, 7 years ago, and he said, "Kid, these products are sold, not bought."
Why Weinstein and his Saba fund are going after closed-end funds, like those managed by BlackRock, to unshackle the $1.4 billion he says is on the line for shareholders.
Sometimes, unlike ETFs, unlike mutual funds, they trade at deep discounts to their objective value, and that discount can be corrected with the press of a button.
Plus, the rest of today's stories that got us squawking. Food news.
Bacon, though. Bacon, bacon, bacon.
New tariffs on China manufacturing, and they're back. The meme stocks return, thanks to what else? Memes on social media.
I mean, he didn't notice improving fundamentals at GameStop, did he? It's not that he said, oh, look.
It's Tuesday, May 14th, 2024. Squawk Pod begins right now.
Stand Becky by in 3, 2, 1. Cue it, please.
Good morning, everybody. Welcome to Squawk Box right here on CNBC. We're live from the NASDAQ market site in Times Square. I'm Becky Quick, along with Joe Kernen and Andrew Ross Sorkin. And on this Tuesday morning, it is Tuesday, right?
Meantime, the Biden administration hiking tariffs on roughly $18 billion worth of Chinese imports. The new levies will target what the White House calls strategic sectors. Steel, aluminum, and battery components will see 25% tariffs. Tariffs on solar cells and semiconductors raising from 25% to 50%, and tariffs on Chinese electric vehicles will quadruple to more than 100%. Chinese EVs were largely locked out of the U.S. market years ago by existing tariffs, and, well, now they're going to stay. Most of the new tariff rates will take effect this year, but some will be phased in over a year or two in order to give U.S. industry time to adjust. This move coming as a result of the Biden administration's review of tariffs that President Trump put in place in 2018. And officials saying that China had not sufficiently changed its behavior, citing IP theft and overcapacity concerns. So they left all those tariffs in place while adding these new ones. White House officials said this is not a political move, but National Economic Director Lael Brainerd did highlight Pennsylvania and Michigan, two swing states, as areas that stand to benefit from these actions. Clearly, they may say it's not political, but this effectively tries to take the China issue, if you will, and the tariff issue even, I think, from Trump off the table to the extent that you can. Having said that, this is also inflationary, which is what former President Trump has been criticized for in his campaign as it relates to tariffs.
Pennsylvania is key in this next election, obviously. It's one of the key places. That's why Wildwood, is right next. It's not going to win New Jersey, but there are a lot of Pennsylvania people that probably were at the MAGA rally.
But what do you make of the China part?
What do you mean? I mean, in terms of it being a tit for tat with what Trump has done. I mean, the tariffs never came off, really.
But that's part of the argument, right? I mean, because what you hear from Trump is he's going to go hard. He's going to go super hard at China.
But who agrees with that? I mean, no real conservatives agree with tariffs. It's just that's not in your conservative playbook. And they always sort of, when they talk about Trump, there's a lot of things as a conservative, there's a lot of things about Trump that you have to accept. For anyone, there's a lot of things you have to accept. It's all part of it.
So then you would be critical of President Biden doing this?
I don't like tariffs. Yeah, do you like tariffs? I don't think they're a good idea. Do you? I don't think you've ever liked tariffs.
I don't love tariffs.
I understand the argument that it's not a level playing field, that China has spent a whole lot of money
they're dumping
manufacturing and dumping some of these things. But we're doing the same thing because we targeted these industries because these are the industries that we are propping up with the IRA and with the CHIPS Act. So these are it's
all part and parcel of the same game.
Right. We're doing the same thing. We're doing the same thing that we are so critical of. I don't know what the WTO would do with any of this. I don't know what our European allies think about any of these issues either. They didn't love the fact that we're spending so much money investing in these critical industries that we see. I do understand the defense argument for it. I think you've got big concerns about what comes with inflation.
But
aluminum, if you're looking at the front page of the Wall Street Journal, there's a whole story about how small businesses pass along inflation steady plane. Yeah. The lead is aluminum and cardboard keep getting more expensive. These are tariffs that are on aluminum.
The tariffs don't go. It's not. We don't collect the tariffs, and we made billions of dollars. That's the other thing that we always hear. Oh wow, how much money?
No, it means that these things don't get shipped here. It means you protect your own industries, like the
and it ends up consumers
from the
end up.
electric vehicles and Tesla. So yes, it's consumers paying the other end of this. We will talk more about it later today, but it's an ongoing argument. You can understand the idea that it's not a level playing field. I don't know how else you tackle it. GameStop shares closing higher by 74% in yesterday's session. And believe it or not, they're up again this morning by another 45%. This comes after the reemergence of bullish internet persona Keith Gill, who's also known as Roaring Kitty. Gill posted an image that seemed to imply that he was sitting up and taking notice. A lot of people figured maybe he's looking at GameStop shares again, maybe he's getting more involved. Then during the market session, he posted a series of dramatic movie clips on his X feed. As of yesterday's close, short sellers in GameStop had lost $1.25 billion just in the month of May alone. That's according to S3. GameStop isn't the only meme stock on the move. You've got AMC and Reddit shares both jumping. If you check things out for the week to date, it's only Tuesday. For week to date, AMC is up by 175%. Reddit is up by 11%. And you maybe thought those short sellers would have learned a lesson, maybe moved a little more carefully, but it does raise all kinds of questions about what's happening with the markets, what's happening with retail investors, how much of this is just the way the markets are going to operate these days.
GameStop had a reverse split, too. The market cap's now back over $1 billion, but I'm sorry, AMC is now over $1 billion, but it was well below $1 billion after
That's when the shorts
split.
got
So
more
it's
active,
up.
too.
But yeah, you figure the shorts, did they learn their lesson? They were once again probably making a lot of money on the short side. But is that what he noticed?
I don't know.
The kitty, he didn't notice improving fundamentals at GameStop, did he? It's not that he said, oh, look, this is going to start being better. You notice that short interest.
Yeah,
that's what you're noticing.
The short interest.
It's the same game.
It's got to be.
Yeah.
Some news this morning about someone we know pretty well on the show. Jimmy Dunn abruptly resigning from the PGA Tour Board yesterday with a letter that expressed frustration at the lack of progress that was being made and that no longer included his input. Dunn was one of the architects behind the PGA Tour's surprise reversal to strike a deal with the Saudi backers of Live Golf. Dunn pointed out that players now outnumber independent directors on the board and said that his vote and his role there is what he called utterly superfluous. There has not been progress made on that deal that was put out. He also said, though, that along with the lawsuits being dismissed, that original agreement with the PIF, it also didn't contain an exclusivity clause. And that's what allowed the investment that came earlier last year from Strategic Sports Group to be made into the PGA, too. I think they were looking at other options, trying to find other investors who might come in on this. That deal originally, the PIF deal, was supposed to be resolved by the end of last year, and it has not.
It's weird. It's kind of fractured, and you can watch both now. The other weekend, there's a PGA event, not this last one, I think it was the week before. And I know most of the golfers, but I didn't really know the top 4 or 5 golfers on the PGA Tour. Over on the Live Golf Tour, which was on a different channel, where it was like watching a Ryder Cup or a major. They were all there, the guys that you see on the leaderboard of the major tournaments. And they're all on like teams. And so in addition to the individual scores, it's like it's weird. And
do you like that better? Is that what you're trying to say?
I just am saying that I was drawn to watching the big names, because the other event I had not heard of, like the top 5. They were really good, the top 5 guys, and it was a great ending the way I ended up back on the PGA. But no, I'm not saying I'm watching them. They have some great players that definitely on Live, and we're still available for some type of venture. I think a business news.
Rory McIlroy quit the PGA board.
Aren't you, Sorkin? 300 is your price?
I don't have a price. It's priceless.
Rory
Stevenson just walked away with
McIlroy.
You saw what he did over the weekend. He just was getting even further away from the rest of the field down in Charlotte. I think it's the Wells Fargo. Anyway, he's got a tiger like when he's playing well, no one's got the swagger.
March down the green.
He's pretty cool. Kraft Heinz is gauging interest in its Oscar Mayer business, the maker of hot dogs, cold cuts, bacon, bologna, all that kind of stuff. It's kind of fallen out of favor I guess, recently. I mean, we're making fake meat, so who wants processed meat? Look at that bacon, though. Bacon, bacon, bacon. That's according to a Wall Street Journal report. Says the company recently hired Bank of America and Centerview Partners to evaluate a potential sale. The Oscar Mayer business reportedly could fetch somewhere between $3 and $5 billion at this point.
Yeah, most of the stuff that gets sold like that is uncured. It doesn't have a lot of the preservatives in it.
The new stuff. Yeah. So you can get something else probably. I mean, preservatives. You know what they do? They
keep you from.
I don't recommend any unpasteurized milk anytime soon.
No, especially not with avian flu around.
Exactly.
Yeah.
Cheese will be next.
Coming up next on Squawk Pod, Wall Street aggressor and famed risk taker Boaz Weinstein is taking on the world's largest asset manager, BlackRock. What are closed-end funds, and why is Weinstein's hedge fund targeting them? Oh, and how much money is on the table for shareholders if he's successful in his campaign?
BlackRock pressed a button, like we've done before 6 dozen times, and allowed investors to get out just at fair value. They don't have to be right about where AMC is going to trade tomorrow. They don't have to be right about the Fed. If it just traded at net asset value, the number is staggering, Andrew. It's $1.4 billion.
All that explained up next in our rare interview with Boaz Weinstein. Welcome back to Squawk Pod from CNBC. Our next guest is Boaz Weinstein, a hedge fund manager who almost never does interviews. He rose to fame on Wall Street during his time at Deutsche Bank in the early 2000s, when at 27, he became the youngest ever global co-head of credit in the bank's history. He made billions for the bank, but he also led the team that lost over $1 billion when Lehman Brothers collapsed. He left Deutsche in 2008 and founded Saba, Hebrew for grandfatherly wisdom, where he really made his mark on Wall Street. Weinstein is best known as the man who harpooned the London whale in 2011. It was one of the biggest trading blowups since the 2008 financial crisis. The London whale was a JP Morgan trader whose moves in the credit derivatives market are responsible for costing the bank over $6 billion, criminal charges against traders, a pay cut for CEO Jamie Dimon, and over $1 billion in SEC fines. JP Morgan's whale made a bet on credit derivatives, a wrong one, and then doubled down to scare off traders on the other side of the bet. Except, credit trader Boaz Weinstein and his hedge fund were on the other side. And at Weinstein's recommendation, hedge funds doubled down on their bets on the index the whale was shorting. And the rest is market history. Boaz Weinstein is famously a big risk taker. As a teenager, he was banned from the Bellagio for counting cards, and he was ranked as a chess life master at age 16. Both games require aggressive risk. The New York Times once called him a monster to his fellow hedge funders with a, quote, preternatural appetite for risk. His fund, Saba, is a tail risk fund, meaning when markets are volatile, his fund makes money. If they suffer a big drop, he's got a hedge. Weinstein currently manages $4.8 billion. Now, Saba's closed-end fund has targeted the world's largest asset manager, BlackRock, in a battle to remove it as manager of 6 funds overseeing $10 billion. And the tension is heating up. It's proxy season. Activists are making moves across finance ahead of upcoming shareholder meetings. Now that you're caught up, let's get back to Andrew Ross Sorkin.
We have relocated this morning. We're right here now at Saba Capital Management's office in Midtown Manhattan, and joining me in a rare and exclusive interview is Boaz Weinstein. He's the founder and CIO of Saba Capital Management, made famous perhaps for the London whale, but now bringing a new activist campaign to BlackRock, which is a fascinating new development in terms of going after their closed-end funds. You've made a strategy of going after closed-end funds now for several years. A lot of folks may not understand what a closed-end fund is. So before we even maybe get into the conversation about what is it that you're trying to do and going after the governance of BlackRock, a firm that's made its name in large part on the back of governance and governance issues, what are you trying to do with BlackRock?
Right. So closed-end funds they've been around for more than a century. A lot of the viewers will recognize the Grayscale Bitcoin Trust as a very famous closed-end fund. It was at a discount for years, a very deep discount. And when it converted into an ETF, the discount disappeared. Investors made something like 80 or 90% from that discount going away. On the New York and London stock exchanges, there are over 700 of these closed-end funds. They're portfolios of assets managed by venerable managers like BlackRock. And sometimes, unlike ETFs, unlike mutual funds, they trade at deep discounts to their objective value. And that discount can be corrected with the press of a button, and that's what we're here to do.
So just let's go into why do closed-end funds, as a matter of practice, seem to run at a discount? They trade at a discount almost across the board.
Right. So there are periods when they're at discounts. And in fact, there are many today that are at premium. But why do the BlackRock ones trade at discounts? And why, in general, do they? It's because there isn't really a sophisticated investor base who wants to own these products. They have high fees. And so at fair value, you could say, I'd rather be in an ETF that does the exact same thing. So I'm not going to buy it unless it's at a discount. And until it gets to double-digit discounts, there aren't really investors like myself that will take up the effort of buying them.
Okay, but what is it exactly that's your problem with BlackRock specifically? And you have been at war, dare I say, with BlackRock now for several years. And you've gone to court with them, too.
Successfully, yes. We won in federal court in December. One of the things we were at war with was that they were violating the Investment Company Act, the sacred 1940 Act, that they prevented us from voting all of our shares, even though the Company Act says every share gets to vote. And in federal court, on summary judgment, the judge said, Saba wins, BlackRock cannot do that anymore. So that was one thing. Our issue is not really about performance, though some of these funds have performed terribly, to use a technical word. In the last 3 years, 9 of the 10 funds that we're even talking about have lost money for investors, negative total return, 9 of these funds. Performance is one thing, but the performance is exacerbated by this discount because a dollar of stuff, whether it's IBM or Bitcoin or municipal bonds that BlackRock manages, despite their $10 trillion in their brand, a dollar of stuff is trading freely for 85 cents, 83 cents, 86 cents on the dollar. And our problem is that having become the largest shareholder in many of these funds, they're actually blocking us from speaking to shareholders. And ISS last year called them out and withheld on their nominees for what ISS termed abusive corporate governance practice.
Let me ask you this, though. Some critics would say, look, the closed-end fund is sold as a closed-end fund, meaning they raise money in the beginning, and the plan is for you to hold it for 12 years, and at the end of the 12 years, you get your money back and hopefully more than that. And yes, it may trade at a discount in between, but that's what it is. And that you, dear sir, are hijacking the process by saying, actually, no, the product shouldn't be this, it should be something else.
Right. So first, most of the funds that they have over 70, are forever funds. They're not 12-year funds. It's only recently that they've kind of tried to split the difference and make it have a term to it. So this idea that a fund that started as one thing needs to be that thing 9 years later, first of all, we don't have a plan to convert it from a closed-end fund into an open-ended fund necessarily. In the last decade, we've done this about 60 times. Most of the time, to get rid of this overhang of too many people wanting to sell it at a discount, the manager goes and buys back those shares. They tender for shares at net asset value, and investors who want to come out. The ones who want to stay can stay in their closed-end fund for 100 years if they want. And often that does get rid of the discount. There was a Neuberger Berman fund that did that, and they are trading today, NHS, at a premium after doing a tender.
How much money do you think is on the table here if you're successful for shareholders?
That's what's wild about this, because traditionally these were small funds, but BlackRock does everything in supersize. These 10 funds that we've nominated people to the board of, if BlackRock pressed a button, like we've done before 6 dozen times, and allowed investors to get out just at fair value. They don't have to be right about where AMC is going to trade tomorrow. They don't have to be right about the Fed. If it just traded at net asset value, the number is staggering, Andrew. It's $1.4 billion.
I want to read you a statement from BlackRock. Obviously, they are not happy about your efforts to try to upend these funds. This is what BlackRock has to say about all this, and maybe you can react to it. They say that BlackRock has a 30-year history of managing closed-end funds for millions of Americans, American retirees, I should say, who they say depend on them for income. Saba is not a champion for the retail investor, but an activist hedge fund, they say, looking to arbitrage funds in order to capture quick profits. This attack is not about governance, performance, or discounts, which narrow over time. It's about executing Saba's well-known playbook, they say, buying controlling positions and forcing short-term changes that harm retail investors to benefit Saba and its hedge fund investors.
There isn't one word, first of all, there isn't one word that they said that's at all accurate. The retail investor benefits exactly the same way as Saba. We haven't achieved some return and we leave everyone else high and dry. The retail investors are some of the least sophisticated investors in the world. The president of BlackRock, I sat in his office, Rob Capito's office, 7 years ago, and he said, "Kid," and I was 43 at the time, he said, "Kid, these products are sold, not bought," meaning no one calls their broker and says, "Get me the latest BlackRock fund." It is pushed on them by their financial advisor. It has slightly higher fees than it should. It has this super long, maybe perpetual term, which BlackRock loves because they get to manage the money forever. And so the idea that the retail investor is relying on funds where, ironically, we're here in a bull market, Andrew. I don't know if you looked at the stock market. These 9 funds are down over the last 3 years. Total return is down, some of them as much as 54%. And so this idea that the shareholder, which all we want to do is vote. We don't want to decide the matter. We just want to be able to vote. The idea that the shareholder needs these funds when there's an infinite number of mutual funds and ETFs with very low fees that BlackRock manages, by the way, the idea that that is not something that is worthwhile for them to take right now, a giant recouping of a loss, to go from 85 cents to 100 cents, we would make investors, and they have not disputed this math, and I've called them out to dispute the math, $1.4 billion would be made if these funds traded as well as their ETFs.
So you don't think that the investors in these funds actually want these funds to begin with? You believe that they've been effectively foisted on these investors?
Look, there's a mix. First of all, there's some sophisticated retail investors that buy the funds that we buy, whether it's copying us or on their own. There are investors that bought it at IPO, and then it's been passed on to them from their descendants. And a lot of these investors who buys high-fee closed-end funds at IPO, the least sophisticated investors, and all we want is to have a fair vote. Now, the thing that will shock is that the vote that BlackRock will take next month is to count people who don't vote as if they were BlackRock votes. And that's the thing that they're doing in this election that makes my head explode, but they would never dare do that for BLK stock. They're treating their shareholders in their stock versus their shareholders in their closed-end fund stock like second-class citizens compared to BLK.
Okay. The critics say the following, and so I'll ask you. You have done this before with several other funds. They're publicly now, GIM and Saba among them. Those trade at a discount too, even today, and you're in control of them.
Right.
So what do you say about that? If yours are not necessarily performing that much better than theirs?
Right. So firstly, the critics are a lobbying group called ICI that works for the managers. Second, our fund, which was the one we took over 3 years ago, the ticker is BRW. People can go to the website and see the letter we wrote. In 2022, the year after we took it over, we were the #1 performing income closed-end fund out of 257 funds. So they can say what they want. Now, to the question of the discount, okay? Right. Good question, right? Tough. That's a hardball question for me. In GIM and in PPR, which became Saba funds, BRW and SABA, we offered investors first a 70% tender, which not even 70% of the shares tendered. We got management to do that. We took it over, and then we offered a 30 tender and then a 15 tender. We offered more than 100% of the shares to be bought back if anyone wanted to.
Meaning investors could get out if they wanted.
At net asset value is the point, or right at asset value. And the investors, some of them did, and some of them said, we want to be with you. We want what you are changing this fund into. And that fund, I'm proud to say, has actually outperformed all of these BlackRock funds by somewhere between 19 and 64%. So let them take shots at my fund.
Okay.
But yes, they are at small discounts. That's true.
Maybe also hardball. Have you lowered the fees on those funds since they became yours?
So one of them is already a very low fee fund. It's only 75 basis points. What we have done is set in place governance. We changed the governance to be best in class. Right. The elections are held annually. The votes are counted on how many votes you get, not the non-voters counting against you. And more than that, the managers of closed-end funds, this is something that's probably not well understood. They charge fees on what's called managed assets. Right. So if they lever up, you pay more fees. Now, when you invest in my hedge fund, if I want to lever up or lever down, it's the same management fee. So for my funds, I have not been running it at full leverage. I've been waiting for there to be an opportunity. We lever up. We don't like it, we lever down, and we're not maximizing fees. These other BlackRock funds are always fully levered.
Okay, I'm going to try one more on you. Okay,
Please.
this is the Ohio Sentinel Tribune op-ed in January. I'm sure you've read it. It says 3 years ago, a hedge fund firm took over a closed-end fund. They changed the investment strategy from a reliable senior loan fund to a fund holding risky assets, including crypto. Worse yet, they liquidated their shares, leaving unwitting retirees holding the bag. The same playbook seems underway on another closed-end fund now. They're referring to this, a Blackstone story. This flies in the face of basic principles of the Investment Community Act, the current law that's intended to separate hedge fund billionaires and fund insiders from the rest of us and stops them from eating our investment lunch.
Right. So again, not a holder of the fund, but a pro-advocacy person putting that story in. So that fund that got into crypto, okay, that's the one I was talking about. First, we offered people an exit near net asset value. And so we gave them the gain that we're asking BlackRock to give to make this $1.4 billion. Then we asked for approval to change the mandate from a reliable loan fund, which was invested in single B junk loans, junk rated loans, and we got approval from ISS. 99% of the shareholders approved those words that you just said. We then invested, and we were the number one fund in 2022. So that's what I have to say about that.
You talked about talking to Rob Capito of BlackRock a long time ago, 7 years ago. Mm-hmm. Have you ever called up Larry Fink about any of this? Does he take your call?
We don't know each other, and I'm perfectly happy to do so. If someone from BlackRock wants to send me his number, I'd be glad to, because if only he did it, it actually would be beautiful for his brand. His employees own these funds. They're rooting for the discount to go away. Who would not want this short-term gain? It's not short-term. We've been in these funds for years. What's the long-term pain? That you might have a smaller fund that BlackRock's managing, that you might have to go to one of a million other choices. $1.4 billion hangs in the balance. And as you know, Andrew, making money, unless you buy GameStop today, is really hard. $1.4 billion can be made literally if it became one of their ETFs or mutual funds, or if they did a tender.
And you've now started a website called Hey BlackRock, trying to get their attention. Trying to get their attention, or maybe trying to get the shareholders' attention. Really
the shareholders' attention. Hey BlackRock.com was set up because when you fill up your account at Schwab or Bank of America, you get asked, do you want to be contacted in these sorts of matters? And BlackRock is not giving us the names of the people who asked to be contacted, which is also unusual. So we have to get the word out, whether it's talking to you on Twitter or heyblackrock.com, where we are going to hold a webinar on the 20th, take investor questions, and go through the plan.
While we have you here, you mentioned GameStop. We've been following that story this morning, and you play in the markets every single day. I see your whole the whole trading floor that way. People can't see it on camera. What do you make of what is happening right now in the markets, and specifically, actually, when you look at a GameStop? I mean, you are an investor. Is this investing?
It's bewildering because we want to make 10%. We want to make 15%. You see something that's up 100%. You don't know why. It feels great because it's up, not down, for those who have it. But it certainly, in some ways, you could say makes a mockery of the challenge of investing, because it can't be justified on anything other than pure speculation. Why today? Why not $1 million a share? And so I look at it and I don't understand it, and I don't want any part of it.
Is this different? We were talking recently on our air with Gary Gensler, and I mentioned the Trump SPAC, for example, which also seems to trade this way. You were involved in that SPAC early and then got out.
So I ended up being one of the 5 largest holders of the Donald Trump Truth Social Trust, because I didn't buy it knowing that. I bought it when it was a SPAC, and then they decided to merge with that company. So, you know, at that point, the SPACs, which we actually had in the funds that you read that Ohio Sentinel piece about, were at a very attractive discount. They were T-bills in a box. Then they decided to buy this Donald Trump Truth Social, and it went to the moon. And I, again, didn't want any part of it, because it's a little bit of greater fool. If it's at 15, it can go to 16. If it's at 50, you feel badly that you sold it at 15, but it was at 9 a minute ago. And so I like when you have this supernormal gain in something to take chips off the table, if I'm lucky enough to even be there.
From a governance perspective and market integrity perspective, given that that's part of what you're talking about here in the context of BlackRock, what do you think should happen? I mean, we had Jay Clayton on earlier, former head of the SEC, and we're talking about market manipulation and the like. Do you think there's something that should happen to the sort of memification of the markets?
I think it's very hard to put in place rules to say this gain is too much, the news doesn't justify that. I think it does feel like greater fool theory, but I'm not sure who's doing something wrong to someone else. Obviously, if there are people pumping it up, but I don't know anything about that. So I really don't have a view about it.
Separately, just you're someone who spends a lot of time both looking at arbitrage opportunities, but also looking at the broader markets and where things are, and I think looking also for cracks in it. Mm-hmm. Where are we in this market? Do you see cracks? Should we be worried? Are you bullish? Are you bearish?
So the market is foggy, right? We had six Fed cuts priced in just a few months ago. Now we have one. Maybe we're going to zero. The way things change, is inflation, has it been kicked? Are we going to have higher for longer? I think that there's a very heightened amount of uncertainty. Even just take the geopolitical skirmishes / wars that we have. And so when you put all that together, higher for longer, which means higher interest rates, which may be great for the lender, but for the borrower is terrible, we are going to, I think, have a credit crunch in the next couple of years if things don't change. And even you take the 100 leading economists, they're pricing about a 35% chance of recession, a hard landing, yet the credit market, just look at corporate credit spreads, are almost at the lows of all time. And so I think that credit does not offer investors any kind of suitable margin of safety right now, corporate credit, that is.
So you just spend all of your cash in the equity world?
Well, we own 6 billion SPACs. I should have said that at the time. Not SPACs, closed-end funds. We used to have 6 billion SPACs.
Yep.
And then we're very involved in protecting pension and endowment portfolios from a sell-off using credit derivatives, which is my domain expertise.
When you look at just even over the next 12 months, we talk about this being an election year and the like, does that change anything?
It's huge. If Trump is elected, it's going to affect the relationship between equity and fixed income markets quite a bit, because he seems to want the stock market to go up, promising across the board tax cuts. Who's going to pay for that? So more debt, higher interest rates. And I would say Trump is likely to lead to more volatility, all things equal, than Biden, although once the election, maybe in both cases there's going to be plenty of volatility, and I'm quite excited for it.
You're quite excited for it. Finally, just on the timing of this whole BlackRock situation, what is the next step in it?
Yeah, so we've sued them again, first successfully last year in federal court for not letting us vote all our shares. This year it's for not counting the votes properly, for basically saying anyone who doesn't vote counts for BlackRock. That suit is going to get some resolution, and then we'll see how the votes will end up being counted. The voting will be done between now and, depending on the fund, July 3rd is when it all is over.
Okay, Boaz Weinstein, thank you for joining us this morning and having us right here this morning to talk about this. Thank you.
Thank you, Andrew.
Appreciate it. Becky, back to you.
Andrew, that was fascinating. Every aspect of it. One very quick question. I don't know if you can answer this. He was saying his fees on his fund are very low at 75 basis points. What are the fees that they're talking about on some of these Blackstone funds? Or BlackRock funds, I'm sorry.
One of mine is 75, one is 1%. Theirs are more like 1.1 range, but their ETFs are about half of that. So if someone went from a ESG closed-end fund run by BlackRock to an ESG open-ended fund run by BlackRock, they would be getting a very similar portfolio, same level of care, and they would save about half the fees.
How important is it for you to ultimately control the funds versus for them simply to shift and do what you want them to do?
Shifting would be massive. In fact, of the 60 or so campaigns, we only ended up running the funds twice. What we want is for shareholders, which we are the largest of, but not in any way the majority, to make that $1.4 billion, which can be done at the press of a button, and they have not disputed that ETFs and mutual funds trade at NAV, tenders at NAV, allow you to get out at NAV, $1.4 billion to their shareholders, and a lot of good brand image from having done so.
Boaz Weinstein, thank you.
We'll be right back. You're listening to Squawk Pod.
Up and Andrew, Q is Mike.
I want to get a check on the meme stocks that are moving this morning, and wow, GameStop was up as much as 160% in the pre-market. Right now, it's up 120%, literally, as we speak. I mean, I don't even know what to say about this. AMC up 106%. BlackBerry. When's the last time you used your BlackBerry? BlackBerry up 25% this morning. The insanity continues.
No, I don't have
the insanity
You were the
continues.
last
I was the last holdout, but I didn't know
the
this.
very last person to get rid of a BlackBerry.
It's just insane. It's insane.
It's the same game. It's the same game. The short interest must have been. I mean, they're short covering right now. What did they say? Short sellers lost $1 billion in the last month or something.
Yeah.
No, it was even less time than that. 1.125 billion, and yeah, maybe it was the last month.
But as you said, nothing has fundamentally changed about the prospects of this company's future has not
Wait
changed
a minute.
in a material way.
He was like this, and then he was like this on the right.
Yes.
Yeah.
He did that.
That
well.
changed. He was, and he's like this now. You say it. April.
I mean, the interesting thing was that the shorts built up a big position again.
Right.
Which
I think that's what he got him to sit up and take
Yeah.
notice, was that the short end. I guess that's what I figured it was.
And nothing has actually changed, folks.
No new games out or anything.
That's all.
What
That's
about
all we have for today?
New Taylor Swift movie at AMC? No,
None of it. Make sure you join us tomorrow. We'll see where these stocks are then.
And that's the pod for today. Hey, thanks for listening. Squawk Box is hosted by Joe Kernen, Becky Quick, and Andrew Ross Sorkin. You can tune in live weekday mornings on CNBC at 6 Eastern. And to get the smartest takes and analysis from our TV show, 3 hours of it, right into your ears in an easy-to-listen-to format, well, follow Squawk Pod wherever you get your podcasts. We'll meet you back here tomorrow.
We are clear. Thanks, guys.